Hey, what's up guys? Welcome back to the channel. My name is Frank Mularcik and this video is episode 5 of my Dow analysis series. So in this video we're going to be doing a brief stock analysis on the fourth company in the Dow by market cap, and that company is 3M, ticker symbol MMM. If you find value in my videos, make sure to like and subscribe so you don't miss out on future content. This is Frank Mularcik. So first of all, we're just going to kind of jump into this spreadsheet I have where I'm tracking all the companies in the Dow and just kind of checking off the ones that we've analyzed so far. So the last video we made was on Dow Inc. So we're going to check that one off. And if you guys have not seen that video, you can go check it out. And what's interesting is these first three companies in the Dow, their market caps, around 40 to 50 billion dollars. And then with the next company, 3M, that we're looking at right now, it jumps up to 83. So I thought that was a little interesting that there's that kind of that big jump there. So right now we're looking at the 2021 10K report for 3M, just looking at some, generic financial results here, I guess. The GAAP earnings per share and adjusted earnings per share were $10.12 for the full year, which the GAAP earnings per share were up 8% year over year, while the adjusted earnings per share were up 14% year over year. That's definitely good to see that their earnings are obviously growing. That's something we're going to talk about later a little bit. And then organic sales were up 8.8% year over year, and basically what that means is that they actually sold 8.8% more items and received revenue that was 8.8% more for those items. But there's also some impact that currency can have on that based on currency fluctuations. So they do account for that. And they said that impacted their sales by about positive 1.6%. And then also, acquisitions and divestitures can also impact that. And that had a negative 0.5% year-over-year impact on sales. So if you add all three of those up, you get a 9.9% increase year-over-year of sales to 35.4 billion, which is pretty awesome. For a company as solid and large as 3M, 10% growth in revenue and 8% growth in earnings is pretty good. Then they also highlighted they invested about $2 billion in research and development in 2021, which is awesome. Obviously, they have to continue to develop new products constantly. Obviously, they have a lot of legacy products, I guess, but they are all constantly innovating to create new products. And the other thing I wanted to highlight here was the sales by business group. So they have these 4 segments: safety and industrial, transportation and electronics, healthcare and consumer. And in all 4 of those segments, their sales increased by about 7 to 10%. And the other thing that we want to look at is sort of this pie chart, which shows the percentage of each group as it's contributing to the overall sales. And we can see that the smallest group is consumer with about 17%, and the largest is safety and industrial with 36%. And the other 2 are right around 25%. So I like that there is diversification there. They're not really relying on one product segment, and it's pretty evenly spread, to be honest. And then the other thing to take a look at is dividends and share repurchases. About 5.6 total billion dollars returned to shareholders, about 3.4 of that in dividends and 2.2 in share repurchases. So that's obviously a good thing to see for shareholders who already own stock. And the other thing I wanted to look at here was just kind of comparing net sales and incomes over, the past 2 years compared to just 2020. So we can see they're growing, grew just a tiny bit from 2019 to 2020 in net sales and continued that growth in 2021. And a similar thing with operating income. It's good to see that they're growing both the top line and bottom line income, with operating income and net income both growing over the past 2 years. Consecutively and steadily. So that's awesome to see, I think. And the last thing we're going to look at in the 10K here is the balance sheet. So first of all, current assets we can see are sitting right now around $15.4 billion, which is about $500 million increase from last year. And if we look through the line items, I think most of that is due to inventories. So inventories were up about 700 million from last year, so that's good to see, I would say. But at the same time, you don't want to be sitting on a lot of inventory. but in this environment, I think it is a good strategy probably to sit on inventory when there's potential supply chain issues and you really don't want to be in the position where you don't have enough inventory to sell to customers. So probably stocking up on a little bit more inventory at this point in time isn't the worst of decisions at all. And then if we compare those total assets those current assets to current liabilities, we can see current liabilities down here of around $9 billion, which is about $1 billion increase from last year, which obviously isn't the best thing, but that is a pretty substantially smaller amount than the current assets. So the current ratio is definitely greater than 1, which is good to see. And the current ratio is just the current assets divided by current liabilities, and that just gives you an idea if they have enough current assets on hand to pay off all the current liabilities within the next year, if that makes sense. And then total assets increasing, or actually total assets decreasing, I meant, by a very small amount, around $250 million. So that's obviously not a good thing to see, but at the same time, it is a small amount, and there's going to be fluctuations there due to various factors. And then net debt, or actually long-term debt, is what we're looking at here, was down almost $2 billion, which is really good to see. And that was something I was really happy to see when I looked at this report, was that their long-term debt was decreasing that much, and their net debt is actually about $4 billion lower than that, I think, because of their cash up here. And then total liabilities also decreased by about $2.5 billion, which is definitely for sure a good thing to see. So overall, I would say the balance sheet is looking pretty strong, and I think that they have plenty of cash on hand, plenty of inventory to continue thriving, while also at the same time they're not just sitting on their cash and inventory and not investing that into research and development per se or something else. And obviously this company does pay dividends, so we're going to look at the dividends real briefly. So the current yield is around 4%, which is super strong. Obviously some of that is related to the stock price that has been decreasing a little bit over the past few months. Payout ratio around 60%, which is very healthy. I have no objections to that. And the dividend growth, they've been growing their dividend for 63 years. I think it's 64 now. Actually, this might be a little bit behind. I think it's 64 consecutive years of growing their dividend, which is one of the longest track records of probably any company on the market. So that really gives me a lot of faith as an investor. But where I start to get a little bit less pleased with the dividend is with the dividend growth rate. This here says the past 5 years they've grown the dividend by about 5.5%, which is true. But if we look at the last few years, the last 2 or 3 years, they've only grown the dividend 1 or less percent. So we can see 2020 they paid $1.47 per share per quarter. 2021 they raised it to $1.48 per share per quarter, which is less than 1% increase. In 2022 they raised it another penny. So again, less than 1% increase there as well. So that's really not something I like to see. I'm really looking for over the next few years for them to increase the dividend a little bit more. That's something I really, really want to see. Otherwise, I would be a little bit discouraged as an investor, I guess. I currently do own some. It's a small amount of my portfolio, but at this point, just because that low dividend increases, I really don't want to add much more, I would say. So next we are going to kind of look at some valuation metrics, and the first thing we're going to take a look at is the PE ratio and kind of compare the PE ratio for 3M kind of historically for themselves. So this bottom chart here is a chart of the PE ratio. So we can see right now it's sitting right around 15, which is sort of in line with where they've been over the past 10 or 15 years. Obviously it was a little bit lower around 2010, a little bit higher around 2018, 2020 range. But I would say in general, it's sort of in line with where they've been. And this bar graph right here is sort of the earnings trailing 12 months net EPS. And what I really like about this is it's just incredibly steady. Obviously, it had a little bit of a fluctuation here, but overall, it's been very steady over the last 10 or 15 years. And it's looking a little bit more steady over the past few quarters as well, which I definitely like to see. And we can also compare their PE ratio to their overall sector, which is the industrials sector. So if we look here, the average for the industrial sector is 20.4. So they're definitely at a little bit of a discount, it seems, compared to the industrial sector. They are in the conglomerates industry here, which has an average of 14.13 for their PE ratio. So For the actual industry, they're kind of right in line with their industry, so not really much that can be taken from that, I guess, but they are a very high quality company. So I was sort of talking about this recently with Matt Money on my live stream, is that, you know, higher quality companies are generally can be expected, and they sort of deserve to trade at a slightly higher PE ratio. So even though 3M is trading a little bit of a higher PE ratio than the conglomerates industry as a whole, you could definitely argue that they sort of deserve that little bit of a higher PE ratio. The next method of valuation we're going to look at is a discounted cash flow calculation that I did. And it's I guess it's not a super simple calculation, but it's fairly straightforward. You just try to predict future cash flows and then discount that back to a current value. And so basically we get that the current value or present value of the free cash flows is around $119 billion, but we want to subtract out net debt. And so net debt is around $12.8 billion. So that gives us a present free cash flow, or present value of the free cash flow minus the debt, of around $106 billion. And there's about 571 million shares outstanding. So then we divide the present value by the shares outstanding to get a fair value per share of $186. And I like to, you know, have a little bit of a margin of safety in there, so we discount that again by 10% to get to our buy price of $167. And currently the stock's right around $147. And so, you know, at this point I would say that is a good price, and I'm definitely happy with that price. And one thing I do want to note is, compared to the last DCF I did, which was on Dow Inc., these numbers, a lot of the revenue numbers and net income numbers, they are extraordinarily consistent, and they're not all over the place. So I have a lot more confidence in these numbers and sort of the resulting buy price and fair value that I'm getting in this calculation. So I think, you know, $147 is a fantastic price for 3M. I think when I did buy my shares, the, you know, few percentage of my portfolio it was around this price just a month or two ago when I started my position. But I really don't want to buy any more unless we see a bit more of a discount, you know, below 140 probably, just because of the dividend growth rate. You know, like I've said before, I just really don't like that. And for me as a dividend investor, I want to be investing in companies that are going to grow their dividends a little bit more quickly than I've seen 3M do. So we're also going to kind of look at a chart as well. I'm definitely not an expert when it comes to charts at all, but I like to kind of take that into account a little bit, and it's definitely another method that you can use in your decision making process. So right now this is sort of a 1 year 1 day chart, and they reached a low just a few months ago of around $139, and they've kind of been sticking in that range recently. They have a lot of volume in here, you know, the 140 to 150 level, so it's probably not going to move anywhere, you know, super drastically within this range, but if it breaks out above or below, it could definitely move a lot fairly quickly. But right now it's kind of sitting around 147. There's kind of some nice support around 140 as well. So again, I think, you know, this is kind of looking like a good level to be buying, and it's just kind of touching up on this 50-day moving average. Let's actually zoom in, because it is kind of touching right on that 50-day moving average. So I would like to see, I don't know if I can get closer, then I guess I can just zoom in like this. Because right now it's kind of touching right on that 50-day moving average. So it'll definitely be interesting to see what happens over the next few days. That could, you know, have an impact for sure. So let me know what you guys do think of 3M stock in the comments down below. For me, I think it's at a good price right now. I think it is a solid company. Obviously, it's not going to be growing super quickly like something like Google per se, but it has incredible fundamentals, a super solid balance sheet. It has been growing its dividend for a long time, and it just has that consistency there that is very valuable in a dividend portfolio for me, where I like consistency and something I can rely on. So let me know what you think down in the comments below. Just want to thank everyone for sticking around to the end of the video, and I'll see you in the next one.